In this example video, we're going to look at review exercises 13-1 and 13-2. So they tell us that on January 1st of 2019, our corporation purchased a 12% 5-year Fleming Corporation bond that has a face value of $200,000. It expects to hold these bonds until maturity, and the bonds pay interest semi-annually on June 30th and December 31st. They tell us that the company paid $215,443, a price that yields a 10% effective annual interest rate. So they want us to prepare the journal entry to record the purchase of these bonds. So when we're looking at investments, we have 3 different levels of investments. We have investments in trading securities, investments in held to maturity securities, and investments in available for sale securities. The only way that we can classify an investment as an investment in a held to maturity security is if the corporation intends to hold that investment, in this case a bond, until it actually matures. It can change their mind at some point during that period of time between when they purchase it and the maturity date. And if that happens, they would reclassify that investment into one of the other 2 categories. But at the time that they make that purchase, if their intent is to hold that bond until it matures, it is then classified as an investment in a held to maturity debt security. So we're going to do the journal entry. So this happened on January 1st, and we're buying an investment. So it is an asset to us. Again, it's an investment in a held to maturity debt security because our intent at the time is to hold it until it matures. We record it at what we've paid for it. So we paid $215,443 for that investment. So that is what we increase our investment account with and decrease our cash with. In review exercise 13-2, it says, referring to the information above, prepare the journal entry on June 30th to record the first interest receipt using that effective interest rate method. So again, they told us that the price is really there to yield a 10% effective annual interest rate. So on June 30th, what we are going to get is cash. That is what we're getting. We're receiving that interest payment that they owe to us. So when we're talking about interest calculations, it's always the face value of the investment, in this case the bond, times the annual interest rate, in this case 12%. And the 12% again is an annual interest rate, but this company is going to be receiving interest payments on a semi-annual basis. So we have to cut that in half because we're going to split the interest payment into 2 separate pieces. So that means we're going to receive $12,000 in cash at that time. What this does is that it reduces our investment account in our held to maturity debt securities. And so we're looking at that. We're going to come back to that because it's going to be kind of our plug number here. And then we have to record interest income. And our interest income, we always take using the effective interest rate method. We take the prior carrying value. So in this case, the $215,443 was the price that we paid. So that was its previous carrying value. We multiply it by the annual effective interest rate, which is 10%. And again, we are recording interest payments every 6 months, so we have to cut that in half. So the interest income that we're actually going to record is $10,772. The difference between the cash that we're receiving and the interest that we are actually recording here is going to be how much we're going to reduce our investment in held to maturities by. We actually paid more on January 1st than the face value of those investments. The face value was $200,000. We paid $215,443. So we basically paid a $15,000 premium for these investments. So when this bond matures, and again, we're planning to hold on to it till maturity, when that bond matures, we are going to get one check from that company that's going to be only for the face value, just for the $200,000. So every time we record interest payment, we need to be reducing the investment account amount so that by the time the investment matures, the balance in the investment account will equal the face value of that investment.